It wasn't a sudden loss of confidence. It wasn't a mere correction of overvalued assets. It wasn't even a natural turn of the business cycle. It was a structural extraction, a calculated exit, a mechanism of transfer so precise that it left the architects wealthy and the public destitute. The history books call it a panic. The arithmetic calls it a liquidation. And the man at the center of the storm didn't just survive it. He profited from it, while the bread lines formed and the factories closed and the suicide rates spiked in the cities. He was counting his winnings, because he knew the one rule that governs the end of every debt supercycle. When the music stops, you don't try to save the dance floor. You grab your coat, you short the venue, and you walk out the back door. This is not a story about a glitch in the system. It is a story about the design of the system. It is about the incentives that drive the men who hold the levers of liquidity. When the incentives align with destruction, destruction becomes the rational choice. The crash of 1929 was not an accident. It was a crime scene. And the fingerprints are still visible on the ticker tape, on the ledger books, and on the Senate hearing transcripts that gathered dust for 90 years. The pattern is unmistakable. The arithmetic is merciless, and the outcome was inevitable. This isn't prophecy. It's positioning under constraints. To understand the mechanics of the collapse, we must first strip away the mythology of the Roaring Twenties. We are often told it was an era of boundless optimism of flappers and jazz of a stock market that reflected a new plateau of American prosperity. But beneath the surface, the foundation was rotting. The prosperity was not built on productivity. It was built on leverage. It was built on the rapid expansion of credit, facilitated by a Federal Reserve that was still in its infancy, unsure of its own power, and heavily influenced by the private bankers it was supposed to regulate. The arithmetic of the era tells a different story than the newsreels. Between 1921 and 1929, the total supply of money in the United States expanded at a rate that far outpaced the growth of the real economy. This excess liquidity had to go somewhere. It did not go into wages, which remained largely stagnant for the industrial worker. It did not go into capital investment in a way that would generate sustainable returns. It flowed as water flows downhill into the asset markets. It flowed into stocks. It flowed into real estate. It created a mirage of wealth that intoxicated an entire generation. But there were men who looked at the numbers and saw the cliff. They saw the ratio of debt to equity. They saw the disconnect between corporate earnings and stock prices. And they saw the fragility of the margin loans that held the entire edifice together. These men were not mystics. They were not clairvoyants. They were simply insiders who understood the constraints of the system. They knew that a credit expansion of that magnitude could not be sustained without a corresponding explosion in real economic output, which simply wasn't there. The constraint engine was priming itself. The Federal Reserve, realizing too late that the speculation had grown uncontrollable, began to tighten the screws in 1928. They raised interest rates. They attempted to drain liquidity from the swamp. For the average investor, for the school teacher in Ohio or the clerk in New York who had borrowed money to buy Radio Corporation of America stock, this tightening was an annoyance, a headwind. But for the elite bankers on Wall Street, it was a signal. It was the ringing of a bell that only they could hear. It meant the cycle had turned. It meant the era of accumulation was over, and the era of distribution and eventual liquidation had begun. The rational move under these constraints is not to hold. It is not to buy the dip. The rational move is to sell everything to move into cash, and if you are ruthless enough, to bet against the very institutions you run. This brings us to case file number 1. The year is 1929, and the man is Albert H. Wiggin. Albert Wiggin was not a fringe speculator. He was not a distinct outsider, throwing rocks at the establishment. He was the establishment. He was the head of Chase National Bank, one of the largest and most prestigious financial institutions in the world. He was a man who sat on the boards of dozens of corporations. He was advised by presidents. His face was the face of American banking stability. When he spoke, the markets listened. When he advised caution, people became cautious. When he advised confidence, people bought. But in the summer of 1929, while publicly projecting an image of unshakable strength, Albert Wiggin was quietly positioning himself for the end of the world. He looked at the balance sheet of his own bank. He saw the quality of the loans Chase had made. He saw the exposure to the stock market. He decided that Chase National Bank stock was overvalued. Think about the implications of that decision. This was his bank. These were the people who had entrusted him with their life savings, their retirements, their futures. And the man charged with protecting that value decided that the most profitable trade available to him was to bet on its destruction. The mechanism he used was complex, designed to be invisible to the public and opaque to the regulators. He did not simply call a broker and place a sell order. That would have been too obvious. It would have panicked the market. Instead, Wiggin utilized a series of private corporations, shell companies effectively, some of which were incorporated in Canada to avoid United States income tax. Through these entities, specifically one known as the Shermer Corporation, named after his daughter, he began to short sell the stock of Chase National Bank. Short selling, for those unfamiliar with the mechanics of this 1920s, was a dangerous game for an outsider. But for an insider, it was a license to print money. To short a stock, you borrow shares from a broker, sell them at the current high price, and wait for the price to crash. Then you buy the shares back at the bottom, return them to the lender, and pocket the difference. The risk, of course, is that the price keeps going up. If the price rises, your losses are theoretically infinite. But Albert Wiggin had an edge that no other short seller had. He controlled the company. He knew the internal data. He knew when the bad news was coming, because he was the one who had signed the press release. He had the power to influence the very price he was betting against. In the months leading up to October 1929, as the frenzy reached its peak, as the shoeshine boy tips became national folklore, Wiggin was aggressively building his short position. He sold over 42,000 shares of his own bank. He was effectively betting against his own team, his own legacy, and his own employees. Then came October. The dates are etched in financial history. Black Thursday, October 24th. Black Tuesday, October 29th. The market didn't just fall. It disintegrated. The psychological floor gave way. Panic is a distinct emotional state, different from fear. Fear is a reaction to a threat. Panic is a reaction to the loss of a way. On the floor of the New York Stock Exchange, the ticker tape fell hours behind. Prices were collapsing so fast that by the time a trade was reported on the tape, the stock was already trading 20 points lower. Men were screaming orders that no one could hear. The clerk at the post could not find a buyer for U.S. Steel. He could not find a buyer for General Motors. And as the price of Chase National Bank stock plummeted, crashing down along with the rest of the market, Albert Wiggin's position grew more and more valuable. Every dollar of value lost by a Chase shareholder was a dollar of profit for the Shermer Corporation. The arithmetic is zero-sum. The wealth did not disappear. It transferred. It moved from the hands of the many who believed in the permanent plateau of prosperity into the hands of the few who had positioned themselves for the collapse. The scale of the windfall was staggering. When the dust settled, Albert Wiggin closed out his short positions. He bought back the stock at pennies on the dollar. His profit from betting against his own bank was over $4 million. In 1929, $4 million was a dynastic fortune. It was enough to buy city blocks. It was tax-free, thanks to his Canadian shell company. And while his depositors waited in lines that stretched around the block, hoping to withdraw enough cash to buy groceries, Wiggin was solvent. He was liquid. He was positioned. This brings us to the aftermath and the investigation that revealed the depth of the rot. It was until years later, during the Senate Banking Committee hearings led by Ferdinand Pecora, the famous Pecora Commission, that the truth came out. Pecora was a relentless prosecutor, a man who understood that financial crimes are often hidden in complexity. He dragged the titans of Wall Street before the committee and peeled back the layers of their operations. When Wiggin took the stand, the revelations shocked the nation. It wasn't just the short selling. It was the fact that the bank had actually lent him the money to finance the trade's Chase National. Bank had provided the liquidity that allowed its own chairman to bet against it. The incentives were perfectly perverse. The bank was financing its own assassination. The public outrage was palpable. The newspapers ran headlines calling for jail time. But here is the key. What Albert Wiggin did was not strictly speaking illegal at the time. It was a violation of trust. It was a violation of fiduciary duty. It was morally bankrupt. But the laws governing insider trading, the laws governing conflict of interest, the laws that we assume exist to protect the market, they were not there. They did not exist because the men who wrote the laws were the same men who benefited from the lack of them. Wiggin was eventually forced to resign. He faced lawsuits from odd shareholders. He settled. He gave up some of his pension, but he did not go to prison. He did not lose his fortune. He lived out the rest of his days in comfort, a wealthy man who had successfully navigated the greatest financial catastrophe in American history. He had played by the rules of the constraint engine. He saw the liquidity drying up. He saw the duration risk. He saw the inevitability of the crash, and he positioned himself accordingly. The lesson of Case File 1 is not just about one man's greed. It is about the structural advantage of the insider. The insider knows that markets are not efficient. They know that markets are emotional, driven by liquidity and leverage. And they know that when the leverage unwinds, the only safety is in being on the other side of the trade. Let us pivot now to case file number 2 to understand where this power comes from. We must go back further to the year 1907. This is the panic of 1907, the crisis that birthed the modern financial system and created the very tools that men like Wiggin would later exploit. In 1907, the United States had no central bank. There was no Federal Reserve to print money, no lender of last resort to bail out failing institutions. The banking system was a web of private trusts and state banks loosely connected and highly vulnerable to runs. The trigger for the 1907 panic was a failed attempt by a group of speculators to corner the market on the stock of the United Copper Company when the scheme collapsed. It brought down the Knickerbocker Trust Company, one of the largest financial institutions in New York. The contagion spread instantly. Depositors, fearing for their savings, rushed to withdraw their money. Banks stopped lending. The stock market crashed. The mechanism of the economy began to seize up. It was a liquidity crisis in its purest form. There was simply not enough cash in the system to satisfy the demands of the depositors. Enter J.P. Morgan, the man, not the bank. In 1907, J.P. Morgan was the de facto central bank of the United States. He was the titan. When the crisis hit, he didn't wait for the government. He summoned the leading bankers of New York to his private library on 36th Street. He locked the doors. He told them that no one was leaving until they had agreed to pool their resources and bail out the weaker banks. The scene in Morgan's library is one of the most pivotal moments in financial history. You had the most powerful men in America sitting amidst rare manuscripts and Renaissance art, playing cards, smoking cigars, and deciding the fate of the national economy. Morgan forced them to pledge millions of dollars to shore up the trust companies. He bullied them. He cajoled them. He used his immense personal authority to force a solution. And it worked. The panic subsided. The system was saved. But the lesson that the bankers took from 1907 was not that J.P. Morgan was a hero. The lesson they took was that reliance on one man was too risky. They realized that they needed a permanent mechanism to guarantee liquidity. They needed a system that could print money on demand, a system that would prevent them from ever having to face a liquidity crisis alone again. This desire for a safety net, for a permanent put option on the banking system, led directly to the secret meeting at Jekyll Island in 1910 and the eventual creation of the Federal Reserve Act in 1913. The Federal Reserve was sold to the public as a way to stabilize the currency and prevent panics, but in practice, it became the engine of credit expansion that fueled the bubble of the 1920s. The creation of the Federal Reserve changed the constraints. Before 1913, a bank that lent too recklessly would fail. It would run out of reserves and close its doors. After 1913, a bank could borrow from the Fed. It could monetize its assets. The risk of total failure was reduced, which ironically encouraged more risk-taking. It created the moral hazard that Albert Wiggin Yav would later exploit. The bankers of 1907 positioned themselves to create a system that would protect them in the future. They didn't just trade the market. They designed the market. They understood that the ultimate positioning is not buying a stock, but writing the rules of the game. The Federal Reserve allowed for the expansion of the money supply that made the Roaring Twenties possible. It provided the fuel. Albert Wiggin and his contemporaries simply lit the match. Now we move to case file number 3. We jump forward in time past the Great Depression, past the wars, to the year 2008. The global financial crisis. The parallels to 1929 and 1907 are not just striking. They are structural. The pattern repeats, but with higher stakes and faster machines. In 2008, the instrument of destruction was not the margin loan or the copper stock. It was the mortgage-backed security, the collateralized debt obligation, the credit default swap complex derivatives that masked the underlying rot of the housing market. Just like in the 1920s, there was a massive expansion of credit. Just like in the 1920s, the regulators were asleep, captured, and just like in the 1920s, the insiders knew the end was coming. Consider the behavior of the major investment banks in 2007 and 2008. While they were still selling mortgage-backed securities to pension funds and municipalities, describing them as safe and A-rated, their own trading desks were aggressively shorting the housing market. They were doing exactly what Albert Wiggin did, but on an industrial scale. The most famous example is Goldman Sachs. The Senate investigations later revealed that while Goldman was marketing these toxic assets to clients, they were simultaneously betting that those assets would become worthless. They called it the Big Short. They positioned themselves so that when the housing market collapsed, they would make billions. But the 2008 crisis introduced a new element, the bailout. In 1929, many banks were allowed to fail. In 2008, the doctrine was too big to fail. The constraints had shifted again. The positioning now involved not just shorting the market, but ensuring that the government would step in to cover the losses. The weekend of Lehman Brothers' collapse in September 2008 echoes the library of J.P. Morgan in 1907. The Treasury Secretary Hank Paulson, the former CEO of Goldman Sachs, gathered the heads of the major banks. They discussed who would live and who would die. Lehman was allowed to fail. Bear Stearns was sold. IG was bailed out. The decisions made in those closed rooms determined the transfer of trillions of dollars of wealth. The Paulson put was the modern version of the Morgan guarantee, but backed by the taxpayer rather than private capital. The insiders who had positioned themselves correctly, who had shorted the subprime market, or who had secured government backstops, emerged from the crisis larger and more powerful than before. The smaller banks were crushed. The homeowners were foreclosed upon. The middle class lost a decade of growth, but the bonus pools on Wall Street recovered within 24 months. The mechanism is clear. In every cycle, 1907, 1929, 2008, the pattern is the same. Stage 1 expansion credit is made cheap, assets inflate. The public is drawn in. Stage 2 distress. The smart money sees the math doesn't work. They quietly exit or go short. Stage 3 collapse. The liquidity is withdrawn. The panic sets in, prices crash. Stage 4 consolidation. The insiders use their liquidity to buy up real assets for pennies on the dollar. Stage 5 regulation. The theater new rules are passed that look like they solve the problem, but actually entrench the incumbents. Stage 6 amnesia. A new generation forgets the pain. Stage 7 repetition. This brings us to the constraint engine. To understand how these men operate, you must understand the 4 forces that bind them: liquidity, duration, inflation, and political risk. Liquidity is the oxygen of the financial system. When it is abundant, anyone can look like a genius. When it is scarce, only the positioned. Survive the insider watches the repo markets, the plumbing of the financial system. When they see stress in the overnight lending markets, as we saw in late 2019 months before the 2020 crash, they know the system is gasping for air. They move to cash. Duration is the risk of time. If you lend money for 30 years at 3% and inflation jumps to 10%, you have lost money. The insider manages duration ruthlessly. When they sense inflation coming, they shorten their duration. They stop buying long-term bonds. They buy things that reset in price, immediately commodities, real estate, gold. Inflation risk is the thief that steals in the night. The insider knows that government debt is mathematically unpayable in real terms. The only way out for the sovereign is to inflate the debt away, to debase the currency. Therefore, the insider does not hold currency. They hold assets that the currency is priced in. Political risk is the wild card. It is the risk of confiscation of capital controls, of windfall taxes. The insider diversifies jurisdiction. They do not keep all their eggs in one basket. They use the Schirmer corporations of the modern era offshore, trusts, multiple passports, legal structures that transcend borders. Current data suggest we are entering the end phase of another massive cycle. The debt-to-GDP ratios of the Western world are higher than they were in 1929 or 2008. The commercial real estate market is showing cracks that remind historians of the early stages of the savings and loan crisis. The unrealized losses on bank balance sheets, losses caused by rising interest rates, are in the hundreds of billions. Most observers agree that the central banks are trapped if they lower rates to save the banks' inflation returns. If they keep rates high to fight inflation, the banks break. This is the false alternative again. They tell you the choice is between inflation and recession. The reality is that the choice has already been made. The choice is financial repression. The smart money is positioning right now. Look at the disclosures. The billionaires are not buying tech stocks at 50 times earnings. They are buying farmland. They are buying gold. They are buying energy infrastructure. They are building bunkers, both literal and financial. They are moving out of the financial abstraction and into the physical reality. They are shorting the dollar not by selling it, but by trading it for things the dollar cannot print. Some economic historians note that this time is different because of the speed of information. They argue that the retail investor is smarter, more connected. They argue that regulation is tighter, but the incentive structure has not changed. The incentive is still to privatize the gains and socialize the losses. The payoff for being first out the door is still exponential. The counter-argument is always the same. They wouldn't let it happen again. The Fed has tools. The system is robust, but the rebuttal is found in the arithmetic. The Fed's tools are inflationary. They can print money, but they cannot print productivity. They cannot print oil. They cannot print trust. When they use their tools, they debase the currency, which is just another form of default. The risk is not removed. It is transferred to the currency holder. To you, we are looking at three potential endgames. Endgame 1, controlled decline. This is the soft landing scenario. The currency loses value slowly, perhaps 5 to 7% per year. The middle class is slowly boiled like a frog. Standards of living decline, but there is no singular crash. This was the British experience from 1945 to 1970. A long, slow slide into irrelevance endgame. 2, chaotic collapse. The confidence evaporates overnight. The bond market revolts. No one wants to hold the debt. The currency collapses. This is the Weimar scenario, or the Venezuela scenario. It is brutal fast and destroys the social fabric. Endgame 3, reset and restructure. The system is acknowledged to be broken. A new currency or a new monetary standard is introduced. Debts are written down or redenominated. This is often accompanied by a bank holiday or capital controls. This happened in the U.S. in 1933 when gold was confiscated and revalued. It is the historical precedent for what many call a Great Reset The only variable is timing and pain. The system will correct. The arithmetic will assert itself. The question is not if, but when, and who will be left holding the bag. The man who shorted his own bank in 1929 understood this. He didn't let sentimentality get in the way of survival. He watched the data. He understood the incentives, and he acted. You do not need to be a billionaire to apply these lessons. You do not need a shell company in Canada. You need to understand where you sit in the capital structure. You need to understand that your bank deposits are unsecured loans to a leveraged institution. You need to understand that in a crisis of liquidity, possession is the only law that matters. Educate yourself on financial history. Look at the data, not the headlines. Build resilience into your life skills, community, tangible assets. Do not rely on a system that was designed to extract value from you. The storm is visible on the horizon. The constraints are tightening. The positioning has begun. Subscribe to the channel.